Okay, so you've brought us a really fascinating set of materials this time, all focusing on Tilray Brands, TLRY.
Mm-hmm.
And it's quite a mix, isn't it? They're operating in cannabis, yeah, but also beverage alcohol,
Mm-hmm.
wellness. It's kind of like they're trying to be this general mills of cannabis
That's
almost.
a good way to put it, yeah. While also juggling things like craft beer and, all the international rules.
Exactly. So for this deep dive, our mission really is to sift through all this and figure out what's actually happening with Tilray. Like, what does this diversification truly mean?
Is it a strength? Or maybe spreading them too thin?
Right. And, for someone just wanted the key takeaways, the solid insights, without getting lost in the weeds, what should they know? Let's get into it.
Okay. Well, the first thing that really stands out from the sources is just how broad their ambition is. They're not just a cannabis company.
No.
They're in recreational medical cannabis,
Yeah.
mostly Canada and Europe. But then there's this whole big beverage alcohol division.
Right. The U.S. craft breweries they bought, Sweetwater, Montauk.
Exactly. And don't forget the pharmaceutical distribution in Germany. That also handles medical cannabis. And then the wellness side, hemp foods, CBD, Manitoba Harvest.
So when we ask what they do, it's a lot. Cultivation, processing, selling, marketing, a whole range of stuff.
It is. And the money comes from selling all these different products through, well, all sorts of channels. Retail, pharmacies, online clinics, wholesale.
It seems like that diversification is really the core strategy here, right? Building this big CPG thing across related but distinct markets.
That's definitely the plan laid out, a global CPG player.
And the scale they're aiming for, it's pretty significant. They're claiming, what, #1 LP in Canada, market share around 12, 13%.
Yeah, somewhere in that range, based on the sources. And they say they're a leader in European medical, especially Germany. Plus, those acquisitions made them like the 5th biggest craft brewer in the U.S.
Global footprint, too. Canada, U.S., Europe, Australia, Latin America.
Yeah.
Backed by some serious growing capacity.
Over 200 metric tons annually, just in Canada.
But here's the catch, maybe. These leadership spots, they're in really tough markets, aren't they? Super competitive, prices getting squeezed.
Exactly. That's the crucial point. Being #1 in market share, well, it doesn't automatically mean you're making the most profit. Far from it sometimes.
So that distinction is key. Okay, taking that back. They're building this big, diversified CPG company, trying to stand out with quality, brands, distribution.
That seems to be the value proposition. But the big question is it actually working financially?
Let's look at the recent numbers. Q3 fiscal 25. What did that show?
Well, cannabis revenue actually dropped pretty significantly, down over 14% compared to last year.
Oh, wow.
The report suggests it's partly strategic, focusing more on international markets, maybe trimming some less profitable product lines back home.
So cutting back to focus sounds logical on the surface.
It does, but the key takeaway is that their main cannabis business is shrinking right now, and the growth elsewhere, well, it isn't quite making up for it yet. So short-term challenge for that diversification strategy.
Okay, what about the other segments? The drinks.
Beverage alcohol was up slightly, about 2%. But that's despite them doing that CQ rationalization, cutting down product variety, which usually drags sales down a bit.
Interesting. So maybe underlying strength there.
Potentially. The distribution side, mostly the German pharma business, that grew strongly, over 8%. And wellness saw steady, sort of modest growth, around 5%.
But overall, the total picture.
Total net revenue was actually down slightly, about 1.3% year over year. The reports say those strategic moves, the product cuts, they definitely had a negative impact across the board for the quarter.
So the moves they're making, they aren't quite delivering overall growth just yet? Makes sense.
Not consistently, no.
Okay, clear picture on the business side. Let's pivot to management. Who's running the show?
The CEO is Irwin Simon. He came from Hain Celestial, so he has a background in consumer packaged goods, which fits the strategy.
Right. And the vision is this dominant global cannabis CPG company. Scale, diversification. He oversaw the Aphria merger, the acquisitions.
He did, but, and this is a pretty big but, his time there has also seen, major net losses. And the stock price, it's taken a huge hit.
Yeah, that raises questions about execution, doesn't it? Despite all the deal-making.
It does. And then there's the executive pay. It's been quite high, which raises eyebrows when the company isn't performing well financially.
Understandably. What about insider trading? Are they buying or selling?
Mostly selling over the past year, looking at the data. Insiders, including the CEO. There have been a few recent buys, but the overall trend is net selling.
Not usually a great sign of confidence.
It definitely raises that question about alignment with shareholders. Simon's success at Hain is noted, but cannabis and craft beer are different beasts, maybe? The track record at Tilray is shareholder value destruction so far.
How have they handled specific crises, like the tariff talk or NASDAQ issues?
Well, on the 2025 tariffs, they did communicate proactively, saying no current impact because they produce locally. That's good communication. And with the NASDAQ noncompliance, they acknowledged it, said they intend to fix it. Standard procedure, really. Maybe a reverse split down the line.
But beneath that, there's this pattern with finances, right? These really optimistic targets get set. I remember that $4 billion revenue goal from a while back.
That one didn't quite pan out.
And then they get revised downwards. It makes you wonder about the initial forecasts or, like, their ability to read the market.
Or adapt quickly enough. And transparency is another point. That short seller report alleging they inflated EBITDA and free cash flow using non-cash stock payments, those are serious claims.
Definitely shakes investor trust, whether true or not.
Absolutely. And then there's that shareholder derivative lawsuit. It's alleging past issues, inventory stuff, a co-branding deal under former leadership.
And claiming the current board hasn't dealt with it properly.
That's the allegation, yeah. So it puts a cloud over the ethical reputation, plus the high exec pay amidst losses. It all adds up to questions.
So if we ask, is management honest, capable, and shareholder-oriented? What's the verdict based on the sources?
Honesty. Questionable, given the allegations. Capable. Well, capable of executing profitably seems weak based on results. Shareholder-oriented. The value destruction and pay kind of argue against that.
Yeah, it doesn't paint a rosy picture. Okay, let's dig into the actual numbers. Financial health. What are the key metrics telling us as of, say, mid-April 2025?
Well, the market cap is way down, around $497 million. That's small cap now. Shows how much value has been lost.
PE ratio. Meaningless with losses, I assume?
Correct. Negative, not useful. Revenue growth, as we said, inconsistent. Negative 1.3% last quarter. And they lowered guidance for the rest of fiscal 25.
So the path to profit still is pretty uncertain. Makes you worry about long-term stability.
Definitely. And the margins are critical here. Gross margin improved a bit to 28% in Q3, but operating and net margins still deep in the red.
That huge gap net margin loss, negative 424%, what drove that?
A big impairment charge. Basically, they had to write down the value of some assets on their books. Huge hit to reported profit.
Which suggests maybe they overpaid for acquisitions or those assets just aren't performing.
Often, yeah. It's a red flag. And even before that, consistent profits have just been elusive for them.
What about debt?
Debt to equity looks manageable on paper, around 0.26. They did reduce some debt recently.
But can they service it without profits?
That's the issue. They need cash flow, which they haven't consistently generated. They reported positive free cash flow last quarter, $12 million.
But didn't you say operating cash flow was negative? And there were those allegations about inflating FCF?
Exactly. So that positive number needs a huge grain of salt. Historically, FCF has been negative. It's inconsistent.
And then price was
super low, 0.18. That screams investor concern about the real value of the assets versus what's on the books and future prospects. Deep concerns.
Okay, so summing up financial stability. Consistently loss-making, volatile earnings. No profit expected soon.
No dividend, unlikely anytime soon. Debt level looks okay relative to equity now, but servicing it depends on cash flow they don't have.
Liquidity. Short-term cash.
Ratios look okay for the short term.
Yeah.
Current ratio 2.54, quick ratio 1.3. But inventory levels are high, which is a risk, especially in cannabis.
So the bottom line is demonstrably unprofitable. History of losses. Balance sheet has manageable debt, but lots of goodwill and intangibles, risking more write-downs. Financial health looks precarious, reliant on cash reserves.
That's a fair summary. It's a tough spot financially.
All right. Definitely a lot to consider there on the financial front. Before we jump into how the market feels about all this and ownership and risks, I want to quickly mention a tool that could help you do this kind of deep dive yourself. Slight pause. Think about being able to get a really comprehensive report, maybe even a summary like this conversation, basically any stock you're curious about whenever you need it, and tailoring it, to how much you already know and how deep you want to go.
Personalized analysis.
Exactly. At stockanalytics.ai, that's what we're building. It's not just data dumps, it's interactive. You can ask specific questions about a company, use a voice-controlled screener to find ideas, even analyze your own portfolio, check for risks, stress test it.
Sounds powerful.
We think so. You can check out the demo over at stockanalytics.ai. We've actually just opened up our waiting list for beta users. There's some pretty significant 50% discounts for early adopters and even ways to potentially invest alongside us.
Good opportunity for people interested.
Yeah, definitely check it out. Sign up at stockanalytics.ai. The link is right there in the description. All right, let's get back to our Tilray deep dive. Welcome back. So we've looked at the business, the management, the financials. Now, how is the market reacting? What's the general feeling out there about Tilray?
Overwhelmingly negative seems to be the consensus from the sources.
You see it in the stock price.
Yeah.
Just hammered across all time frames.
Absolutely. Short term, long term, it's been ugly. And that NASDAQ non-compliance notice, that's a concrete sign of serious market concern.
What's fueling it? The lack of profit.
That's a huge part. Lack of profit, missing expectations repeatedly, the intense competition, regulatory uncertainty, and worries about how they're spending their money, capital allocation.
It feels like the negativity is pretty deep-rooted in the fundamentals.
It does. It's not just temporary sentiment. Look at how recent news played out, the Q3 earnings.
Yeah, what happened there? Adjusted EPS met expectations, didn't it?
It did, but revenue missed. And that massive gap loss because of the impairment charge, it just overshadowed everything. Plus, they cut revenue guidance again.
So any initial stock bump just fizzled?
Pretty much immediately, yeah. Confidence just isn't there.
And the tariff news, they said no direct impact.
Right, because of local production, but, broader trade uncertainty.
Yeah.
That still hangs over a global company like this. Investors get nervous.
And the NASDAQ notice itself is just bad news, period. Highlights that delisting risk.
Exactly. Even things that should be positive, like new product launches or partnerships, they seem to barely make a ripple against this negative tide.
What are the analysts saying? I saw the consensus is hold.
It is, but reading between the lines, that hold feels more like a lack of conviction than actual optimism. Like they don't want to say sell on a stock that's already down so much, maybe.
Could be. Are their price targets reflecting confidence?
Not really. They're all over the place, first of all. And the trend after the Q3 earnings was definitely downwards. Less confidence, more uncertainty reflected in those targets.
Okay, and what about trading indicators? Short interest.
Exceptionally high and rising. Around 18% of the float last checked. Huge number of people betting the price goes down further.
Wow, that's significant bearishness.
It really is. And the days to cover is high, too, meaning it would take a while for all those shorts to buy back shares if they had to. Shows conviction.
Is there any contrarian signal? Options market, maybe?
It's interesting, actually. The put-call ratio, looking at open interest, is low, skewed towards calls, suggesting more bullish bets than bearish ones in the options market.
Huh. So options traders are more optimistic than short sellers.
It could be speculation, maybe hoping for a rebound, or even a short squeeze. But the implied volatility is sky high, over 118%.
Meaning the market expects massive price swings.
Exactly. So you've got this polarized situation, lots of shorts betting against it, but some speculative call buying, and everyone expects fireworks, a real battleground.
Definitely sounds volatile. Okay, let's look at who owns the stock. Institutions.
Relatively low ownership, like 10 to 12%.
Who are the main holders then?
A lot of thematic ETFs, cannabis ETFs, things like that, trading firms, hedge funds, some passive index funds, but not many big, long-term active managers with concentrated positions.
So not a lot of strong institutional conviction.
Doesn't seem like it, no, which suggests a lack of deep belief in the long-term story from the big money.
What about insiders? We touched on their selling.
Yeah, insider holdings are also low, under 2%. And as we said, significant net selling over the past year, including the CEO and CFO. It overshadows the few recent buys. Not a confidence booster.
No. So if institutions own little, insiders own little. Who owns the rest?
Retail investors.
Yeah.
Individual investors hold the vast majority, probably somewhere between 87 and 89%.
Wow, that's huge. What does that mean for the stock?
High retail ownership usually means the price can be really swayed by individual investor sentiment, social media buzz, news headlines. It can lead to that high volatility we just talked about.
And corporate governance. Does that ownership structure have an impact?
It can. Organizing shareholders for proposals can be harder with a fragmented retail base. Plus, you still have those other governance concerns we mentioned.
Right. The shareholder lawsuit, questioning board independence, the executive pay issues, the NASDAQ non-compliance. It all adds up.
Yeah, it creates a backdrop of governance worries on top of everything else.
Okay, so high retail ownership, low institutional conviction. Insider selling, governance questions. Let's try to pull this all together with a SWOT analysis. Strengths, weaknesses, opportunities, threats. What are the strengths?
Okay, strengths. Diversified revenue streams, like we discussed. They do have leading market share in some key areas: Canada, Europe, medical, strong U.S. beverage presence now, global infrastructure is in place, recognized brands, and they have cut some debt recently.
Fair enough. Weaknesses. Feels like a longer list.
It kind of is. Persistent unprofitability is number one. Negative ROIC. Doesn't seem to be a strong economic moat protecting them. Lots of goodwill and intangibles on the books. That's impairment risk right there.
Which we saw bite them last quarter.
Exactly. Inconsistent revenue growth, negative operating cash flow, still relying on external capital, and those questions about management capability and alignment.
Okay. Opportunities.
Yeah.
Where's the potential upside?
U.S. legalization or rescheduling is a big one, obviously. Huge potential market. Growth in other international markets, too. Cannabis beverages, wellness products, and those markets are expanding.
Consolidation in Canada, maybe?
Could be. Leveraging that U.S. drink distribution network if cannabis rules change there. And cost savings initiatives they're working on could help the bottom line.
And finally, threats. What keeps them up at night?
Intense competition everywhere. Price compression, especially in Canada. Regulatory uncertainty, always a factor in cannabis. That NASDAQ delisting risk is immediate and real.
Potential tariff impacts, even if indirect.
Yeah. Negative market sentiment making it hard to raise capital. Risks integrating all those acquisitions smoothly. The shareholder lawsuits. And, the illicit market is always competition.
Let's zoom in on a couple of key risks. Financial viability.
It's a major concern. Relying on cash reserves because of ongoing losses, that can't last forever. Long-term viability is definitely questionable without a path to profit.
Competition and regulation.
Fierce competition, constantly shifting regulations in the U.S. and globally. Huge uncertainties.
NASDAQ delisting.
Immediate critical threat. A reverse split to fix it might solve the NASDAQ problem, but often leads to more selling pressure. It carries its own risks.
And those 2025 U.S. tariffs? Management says no direct impact.
Right, due to local production. But the indirect risks seem significant, based on the sources. Supply chain cost inflation, maybe, if their suppliers get hit. Export market access could be an issue if other countries retaliate. Competitive dynamics could shift. And just overall negative investor sentiment from trade wars.
Seems like management's assessment might be a bit narrow, perhaps understating those knock-on effects.
It's possible. Prudent to consider the wider impacts.
Okay, so wrapping this section up, Tilray is, it's complex, big ambitions, wide footprint, but facing really significant financial and operational hurdles.
Definitely. Potential upside catalysts exist, especially around regulations, but the immediate risks and the track record, they raise serious red flags, particularly for a value-focused investor.
Which leads to a really interesting question, doesn't it? After digging into all this, does Tilray actually have what someone like Warren Buffett would call an economic moat?
Yeah.
A real durable competitive advantage.
Or is it more like a high-stakes gamble, betting on things like legalization happening, betting they can execute better in the future?
Exactly. Is there a fortress protecting this business? Or is it built on potentially shifting sands? That's the question we'll tackle next, using that classic value investing lens. So in our next segment, we're going to take that step back. We'll evaluate Tilray using Warren Buffett's core principles. Is the business understandable? Favorable long-term prospects? Honest, capable management? Does it have that durable competitive edge? Is capital allocation rational? And, crucially, is the price attractive?
Applying that framework should give a really valuable perspective to synthesize everything we've discussed today.
Absolutely. And if you found this deep dive useful and want more in-depth analysis like this, please do subscribe to the Stock Analytics AI YouTube channel. We'll keep digging into companies and market trends. Just a reminder, of course, this analysis is based on information available as of April 11th, 2025. Things change fast in the market. This is purely for informational purposes, not financial advice.
Definitely do your own research. This doesn't constitute personalized recommendations.
Right. And AI did play a role in helping us process and summarize the source materials for today's deep dive.